As a high-income professional, you need to understand that you're not the ideal customer for banks and financial services companies. I'm Justin Hitt with Sustainable Wealth Secrets. If you want to grow your wealth in challenging economic times, you cannot rely on a bank to help you out. First off, as a high-income professional with a high credit score, you are low profits for the bank. Now, it is true that you're low risk for the bank and that you have the ability to pay back any money that you borrow. But in the banking world, a basket of low-income, middle-income customers is way more profitable than a high-income professional. Let me give you some reasons. First off, if you've got a high income and a high credit score, you have choice. So if the bank can't give you the perfect deal, there's always another bank that can give you a perfect deal. And then there's also options like starting a business or using different types of financial instruments, using equity in your home, buying assets that cash flow. See, you have so many choices that a bank cannot lock you in as a permanent customer and cycle you through credit cards and cycle you through different types of loans and get overdraft fees and all these benefits that come with a portfolio of low to middle income individuals. Another thing with a bank is that they are closing accounts, especially credit lines right now, because they know that economically we're facing inflation, costs are going up, and wages are further stagnating. The government is paying people to stay home. There's a period of time where that free money was spent in the marketplace. It was used to pay off debt. But now when that free money turns off, individuals are going to have to dig into their credit cards, dig into their credit lines, and then start using their credit, but not being able to pay off their credit. It does have value to a corporation, to a financial services firm, to have millions of individuals paying in payments every month, covering debt, and not really being able to get out of that debt. However, credit lines tend to be the lowest interest rates available. They tend to be unsecured. They tend to be really good deals. Home equity lines of credits are secured, but they're, again, very low interest rates, and people tend to pay them off quickly. And individuals with high incomes are going to be able to pay off their debt completely when they start realizing how much interest they pay out every month. That's why we teach calculating your cost of capital. If your cost of capital is 7, 8, 9, 10%, you can very easily negotiate with smaller regional banks and get low 5%, 2%, depending on what kind of collateral you have or if it's unsecured, but you can get lower interest rates to bring down your cost of capital. So there's no reason to have a 26% interest credit card. There's no reason to have 15, 20% interest credit cards. Now, credit card companies, finance companies, are going after those low to middle income individuals, offering them giant perks. But a high income professional isn't going to be really that excited about perks. What the hell are you going to do with air miles? Until they figure out COVID, until they figure out travel restrictions, what the hell are you going to do with air miles? I've gotten 50, 60, 100,000 air miles here and there. I simply use them to pay for relatives' airfare so that they can come visit me rather than driving 12 hours. This is how it works with high-income professionals who have high credit scores. Yes, you would think the banks would want to work with lower-risk individuals, but with the history of banks being bailed out by the government, by tax programs that back end a lot of these funds, SBA loans that back end a lot of these funds, and then also the fact that the Federal Reserve has been giving away money at negative interest rates to the financial services firms. They want to lend out as much of that money as possible, get the highest interest rate return on that I wouldn't call it an investment, but that loan to an individual who will be able to quickly and easily get a new job if they lose their job. See, as a high-income professional, you're not going to be able to find a new job so quickly. You're making $150,000 a year, $250,000 a year. You're just not going to pick up that next job very easily. So you're going to need a different type of debt strategy. Now, I'm not against debt. Managing debt properly as a portfolio with the right approach is going to help you generate wealth quickly, mostly because you can buy assets that cash flow, and you can use the cash flow to pay off the debt. Now, a lot of individuals were using their personal lines of credit to buy real estate, to rent that real estate out, and then the rental payments were actually covering the payment or the minimal payment that was necessary for the line of credit. Line of credits were also used for rehab and repair. Line of credits are also used for emergencies, so they're not very active accounts. Where on the other case, your credit card lines are very active, and the bank actually gets a percentage of the credit card transaction fees. So it's actually a better revenue stream for the company. So why have lines of credit when you can make people use credit cards and personal loans and make more money? So what do we have to do? As a high income professional, you need to focus not running your credit like a consumer. We talk a lot about being a producer. You need to find something where you can establish a business and use business funding to cover your wealth accumulation. Let me explain how that works. I mentioned real estate. Rather than having one or two properties as a individual, you need to open up an LLC and run your real estate portfolio as an active investor. This is going to give you a tax break. Now, again, I'm not a CPA. I'm not your accountant. You need to talk with your individual advisors for what's specific for you. This is a podcast with general information. But the concept is, as an active investor, you're going to reduce your tax liability, but you're also going to be able to demonstrate with better P&L reports, with better rent rolls. You're going to be able to demonstrate to a bank, credit union, financial services company, or even private investors that you're running a real business. And this real business has income and liabilities, and it is separate from you as an individual. So you have your personal credit score, but now you're starting to establish a business credit score. So they look you up in Dun & Bradstreet. They look your company up in Dun & Bradstreet. You actually have a business line or a business credit score. This allows you to take personal loans or personal lines of credit when the interest rates are best for individuals. That money gets invested into your company, or to take business lines of credit or business loans when it is advantageous to do so. Now, in the case, it doesn't have to be real estate. You could have a services business. You could have a consulting business. You could your spouse could have a business. Whatever it is, that business is going to have another profile in the marketplace that gives you access to capital. So in the case of COVID, if you had a small coffee shop, and you enjoy coffee, and you have this coffee shop, and you're participating in community, and this is giving you access to people and relationships and events and activities, and the coffee shop is barely making any money. It pays its rent, it pays for its product, it pays for a few employees, but you as the owner is not making anything. But your spouse is working a full-time job, making a high income. You can actually shift your expenses appropriately for, I'm always about you being able to pass a tax audit. So this information is general purposed here as an illustration, but you can balance your expenses appropriately. And then rather than putting your income money into your business, the business can get its own credit score, can get its own lines of credit, can get its own influx, primarily getting your income from the business through customers, but ultimately you can now, from the salary side, put 25% into your 401k. So that income gets invested. The investments make a greater return than your cost of capital. And now you have a cost of capital as an individual and a cost of capital as a business. Rather than shifting your income between yourself and the business, you can now use the income of the business to shift between the business and yourself. This is a concept of both multiple streams of income and debt strategy. So debt held in a business offsets the income and provides you a lower tax basis. So if your business, for example, needs a building and you purchase a building, a friend of mine growing up, he had a furniture store. And his family used to live outside of town and drive every day to the furniture store. Well, he found a new location to open his furniture store that had apartments over top of the furniture store. So he moved to the new location. He sold the original property he was at. He was downsizing anyway. And him and his wife lived over top of the furniture store, and the furniture store paid their mortgage. So rather than having $1,200 a month, and I'm using today's dollars, $1,200 a month, $2,000 a month for your housing expenses, that was covered by the business that he already had. And then the business itself could reinvest that money to grow the business, but also to fill qualified retirement accounts. Now, part of a debt strategy for wealthy or high-income individuals, and by the way, if you've got a high income, you're in the best position to convert that to wealth. That's what we talk about here. But a good strategy is to not pay off all your debt, but instead structure your debt in such a way that the assets that the debt had helped you purchase. I'm not talking about you going into debt in a business so that you can buy a boat that you spend every weekend out fishing on. I'm not talking about buying a bigger house so that one day it might appreciate, it might have some equity. I'm talking about a modest living, intentional thrift, and using debt to buy assets that cash flow. Those assets spin off income that covers both the maintenance of the asset and the debt obligation of the asset, leaving you 3 to 5% return on that investment. Now, I encourage you to track the amount of time that you put into something like this, because I know a lot of folks are saying, well, how much time? I'm already so busy working my professional job. How much time am I have to put in? Well, again, I'm using real estate as an example. I'm using a furniture store as an example. I'm using a coffee shop as an example because people are familiar with these things. But I've known people that are husband and wife teams that started out with one person working for a government contractor and the other person starting a consultancy business. And now it's a husband and wife team running a government contracting agency with 19 employees serving clients all over the United States. The business, what kind of business, it doesn't matter so much as the structure of giving yourself an independent business credit score and your own independent credit score. Now, you can even raise your credit score of your children through some of these debt strategies. So as a high-income professional, when your child goes to college or your child goes into a trade, they may need credit. So right now, you can put them on your credit cards to help share some of that credit score. Now, by the way, you do not give them a credit card. You simply put their name on the card so that they benefit from your repayment habits. But ultimately, they're going to go into a marketplace with people looking at your income, and they're going to be left out of a lot of these new opportunities. Now, you can also teach your child about this whole middle and low incomes where the banks are making a lot of money. And that's why banks offer these cash back programs. They're going to offer cash back when you spend money at Starbucks. Well, Starbucks is a great experience, but it's overpriced coffee. And if you're trying to get 5% back from a Starbucks experience every day, you could have gotten 5%, 10%, 20% or more on the money you'd save by choosing an alternative. That's simply what works as a debt strategy for high-income professionals. So let me give you a quick rundown before I wrap up. You're going to, whether or not you have a business, number one, if you want to grow wealth in trying times, and ahead of this crash that's coming, and that's the reason banks are starting to pull back their credit lines for high-income professionals, credit lines for people with high business scores, their credit scores. They're tuning their portfolios. Now, they are taking the people on the bottom and just taking their credit lines away as well, but poor people don't tend to have credit lines. Anyway, the first thing you're going to do is you're going to manage money like a business. Okay, you could have an actual business. You could have a family trust. It doesn't matter, but you're going to manage money like a business. That means you're going to allocate funds for specific purposes with the intention that is not spending. It is production. It is investing. It is multiplying the income that you have so that you can keep more of it. Number two is you're going to focus on the growth of free net cash flow, not on your income. Because you could make $1 million a year and spend $1.5 million. And the perfect example, I was making $98,000 a year running a computer consultancy business. I was doing that in the 90s, coming into the 2000s, and the dot-com crash. Now, more than 60% of my clients at the time were dot-com customers backed by venture capitalists. And when the blood hit the streets, My $250,000 401k portfolio, I think it was a simple IRA because it was in the business. It went from $250,000 to about $12,000. My clients were drying up and floating away. I had $367,000 in overdue receivables where the companies just simply vaporized. I ended up making a lot of mistakes. I talk about that in other programs. I spent like $190,000 chasing the money. The one thing I was not looking at, I was thinking about that $98,000 I'm making a year. I'm thinking about all these other things that are going up. I'm not looking at free net cash flow. In fact, while I was making $98,000 a year, I was spending $122,000 a year. Now, these are in $2,000, okay? These are in year $2,000. That's a significant amount of money today. But because I wasn't looking at free net cash flow, I was digging a hole deeper and deeper and deeper. And the hole wasn't necessarily in debt. It was expenditures that didn't pay back. It was borrowing personally to pay for problems in the business and borrowing in the business to pay for problems in the personal. It was a lot of administrative overhead to keep the money separate. So if you run your money like a business, you're going to have compartmentalization. If you focus on free net cash flow, you're going to make sure each of the compartments or the departments in your setup have cash flow, and you're going to more easily be able to cut those things that are costing you money. Number 3, and the final piece of advice for this podcast, is learn about economics so that you can be proactive. It is okay in an inflationary time to have fixed rate debt as long as you have the cash flow to cover it, because you'll be paying back debt with inflated dollars. I talked about this in another program, so I won't dig into it here. But these 3 concepts are going to help you transform your income into wealth. It's going to cushion you against changes in the marketplace, which could include getting laid off and having your income drop significantly. Think about those people that had a line of credit sitting there as security against the 6 to 8 months or even a year it might take to find another job. The security they had where they didn't have to rely on the government. And they were fiscally responsible with their money, but what that means to banks is that they were paying back loans early, that they weren't very good income streams when it came to overdraft. And that ultimately, because those credit scores were climbing, it demonstrated that they weren't going to be desperate to pay high interest rates. Remember, folks, the economic system around you is very complex. If you don't approach it with awareness of those complexities, you'll fall into the traps of the incentives around home ownership and, chasing home prices going up rather than buying discounted properties when prices have already fallen. You're going to miss out on the opportunity of structure. You're going to be in an awkward and frustrating system. The last thing I want to leave you with is that during just about every Democratic every president from the Democratic Party, there has been some kind of economic problem. Now, you could argue that the Republicans create the economic problem to make the Democratic president look bad. You could argue that the Democratic president is a little bit more free with the benefits programs and welfare and different things, and that causes problems. It doesn't really matter why the problems happen. Just understand inflation is here and inflation is increasing. And if you aren't using a high income debt strategy, if you're listening to Susie Orman or Dave Ramsey and you're not using the right debt strategy, you're going to be left behind. You're going to struggle and be frustrated. The wrong kind of debt is going to kill you. High interest rates, these floating, banks don't want fixed rate lines of credit. They don't want fixed rate personal loans, especially when the Federal Reserve is going to increase interest rates to slow down inflation. Folks, you're in the right place. If you make $100,000 or more in the United States, or you're twice the average income, 3 times the average income in your area, you are in the right place with this newsletter. The challenge is connecting with these ideas and concepts and using them in your daily strategy. Now, strategy implies you're writing down a plan and so that you can get ahead. I gave you 3 key steps here that are going to get you aligned in the right direction so that you can grow wealth in trying times and get ahead of the crash that's coming. Now, if a crash doesn't come, guess what? You're still going to be in a best position because you understand banks are not making any money off you. So they're not going to bend over backwards to take care of you. There are ways to structure so that you can be a prime candidate for lending, but also that you probably don't need to borrow any money. And then if you don't need to borrow money and you're creating wealth, or you've got assets that cash flow, you can inject new funds into it through other forms, investors, joint ventures, actually just get the money from your customers. This is sustainable wealth. It is a portfolio approach that manages the money like a business would, that looks at growth through net cash flow, and it understands concepts of economics so that you're in the right place at the right time. I'm Justin Hitt with Sustainable Wealth Secrets. Visit us at www.sustainablewealthsecrets.com. What we teach transforms your income into wealth that cannot be taken away, systems of understanding that even if you lost everything, you could just get it back. As long as you don't have like a brain injury, you can certainly just use the strategies appropriately for the current market conditions, forecasting out on paper, and then just get the money back. Actually, if you've ever had a bankruptcy or you fear bankruptcy, you can just reset and start over. The Great Reset is not a bad thing if you understand how the system works. Anyway, write with your questions, fax our offices. I'd love to hear from you. I'm Justin Hitt with Sustainable Wealth Secrets. Thanks for listening.